It looks like all the depositors will be made whole as the US government moves in to save the banking system in the Silicon Valley banking-led crisis. And so that's what I'm going to cover in this video. So guys, as you smash that like button, let me run that intro. What's up guys, and welcome back to the channel. And what a difference just one day makes. Now it's around 4:30 or 5 o'clock a.m. Eastern time here, and I actually went to bed early last night. I had this whole video made to record this morning, and then of course last night after dinner time around, they actually released that they were going to save the banking system by making sure that the depositors were made whole. So it's very crazy how quickly this whole story transpired, and I just wanted to wait and talk about it once I really understood exactly what was happening. And so let's dive into exactly what's happening. So on Sunday, Treasury Secretary Janet Yellen actually went on TV on the show called CBS Face the Nation, and she said that the US government will not bail out Silicon Valley Bank. And I just don't think that that was the right thing to say at the time. I mean, this was just yesterday, and what she said is that the reforms that have been put in place means that we're not going to do that again. Okay, fine, but you know, the point that I made is that if you don't protect the depositors, at least you're going to run into a huge problem that could be systemic. And so I just think that I misunderstood what she was saying. That's really it, because I came back and I said that bailing out the bank sector isn't a choice you get to make. It's something you have to do. If you recall, guys, for any of you guys that were around in the 2008-2009 banking crisis, they didn't want to bail out the banks then either. And so, you know, they just did it because they had to, because they realized that the whole thing was going to go down if they didn't do it. And so this is what I woke up to this morning. SVP and Signature Bank depositors are going to get all their money as the Fed moves to stem the crisis. And so the regulators actually took control of a second bank, and they're rolling out emergency measures to make sure that there isn't no contagion sort of like impact. And here's a little bit more detail on that. So on Sunday night, the US announced emergency measures to ease the fears that depositors might pull their money from smaller lenders, and that's exactly what probably would have happened. And so the measures include guaranteeing all deposits of SVP, which are essentially designed to shore up any sort of like wavering confidence in the banking system. But that's not the most important part. Here's the most important part. The Fed and the Treasury separately said that they would use emergency lending authorities to make more funds available to meet demands for bank withdrawals, an additional effort to prevent runs on other banks. And this is the most important point, and I'm going to explain in this video why this is what they needed to do from the beginning. I mean, you know, you need to give them some time to work, and so I'm not criticizing them at all or anything. I just found what Janet Yellen said Sunday morning to be a little bit sort of like off-putting, but once again, I may have just misinterpreted what she was saying. Now, they are all coming out and saying that this doesn't constitute a bailout because the stock and bond holders in SVP and Signature Bank won't be protected. Okay, fine. So you can have your political win at the same time while you shore up the banking system. Let's give them that. And before I get into the details, this is just an explanation of how large this collapse is. Remember, SVB is a top 20 bank, and so notice how large it is relative to Washington Mutual. WAMU, I guess that's what we used to call it back in the day, WAMU. And so notice how close in size these two are. So this is not a small bankruptcy at all. And I know this story transpired really quickly, so there's a lot of you guys who don't really even know what's really going on, and really I didn't until I really dug in yesterday. And so in order to sort of like explain why that second point of what the regulators are doing is the most important part, let's start with where we have come from. And so, you know what, here's a really good article by the Wall Street Journal. I wanted to point it out to you guys because I want you guys to take a look at it and read it if you can, but they did a really good job of answering the questions with what was going on with Silicon Valley Bank. So first, you guys know that Silicon Valley Bank was closed by the regulators late last week, and the FDIC took control of the company. And notice, recall guys, that this bank is largely used by pretty much all tech startups. And so, you know, some of the tech startups were rushing to transfer their money out of the bank when it got shut down. In other words, there was a run-on happening on the bank. And so the question is, how did we get here? Well, Silicon Valley Bank, you know, they do have many startups and venture capital firms as their clients, and these clients generated a ton of money during the COVID surge, which of course increased the deposits as SVB significantly. And so that actually skyrocketed their deposits to up to $200 billion by the end of the first quarter of 2022. And so what SVB did is that they bought billions of dollars of what they believed at the time were safe assets, which were primarily longer term US Treasuries and government-backed mortgage securities. And so, this is not a bad strategy. However, you can run into a problem when you buy these things if the interest rates go up simultaneously with your depositors looking to take their money out. And I'm going to explain that in a second. And so here's the problem. These securities are at virtually no risk of defaulting, but they pay fixed interest rates for many years. That isn't necessarily a problem. No, it's not at all, unless the bank suddenly needs to sell the securities. And the only reason why the bank would suddenly need to sell the securities is if they started taking huge lending losses, or if there was a lot of depositors that were looking to take their money out all simultaneously. And so that it's the latter that happened. And so this wasn't an underwriting led issue. So anybody who says or is comparing this to 2008, they're wrong. This is a different situation. And so because market interest rates have moved so much higher, these securities are suddenly worth less on the open market than they were valued on the bank's books. And so let's go back to Finance 101 here. Recall, guys, that the principal value of fixed rate instruments move inversely with interest rate increases. So when rates go up, the fixed rate instrument principal values go down to keep up with the changing rate environment. And the reason why the principal rates go down is because the interest rates are fixed. In order for you to get that high yield, which matches the current market yield, because the interest rates have gone up since that instrument has been issued, the principal price has to go down. So it's the same amount of interest over a lower amount of principal, and thus the yield is higher. And so that's what's happening here. So if you hold these instruments into the time that they mature, you incur zero losses. But if you sell them prematurely in a rising interest rate environment, you're going to have principal losses. And so as a result, they could only be sold at a loss, as they said right here. And so far there is no problem, because once again, they can just hold the instruments to maturity and get back 100% of the principal value of the securities. I hope that makes sense for you guys so far. Now let's go into what this second issue is, which I've already alluded to, but let's dive into that a little bit more. So you can see here in the section of where they say what else went wrong. At the same time, while SVP's principal value on their securities were declining, deposit inflows actually turned into outflows as clients burned cash and stopped getting new funds from public offerings and fundraisings. So if the depositors are coming down because they're pulling money out of the bank, the bank has to make cash available to satisfy those withdrawal requests. Well, when they run out of cash, they need to start selling off some of these investment securities, and they inevitably end up selling them off at huge losses, which causes a lot of fear. And what that will inevitably end up doing is cause people to pull more deposits out. So it just creates a run-on effect driven by fear and kind of like risk management. And so that's what actually ended up happening. So on Wednesday, SVP said that it had sold a large chunk of its securities worth about $21 billion at the time, and they took a loss of $1.8 billion after tax. And so what this did is that this immediately tipped off Treasury people, I'd say just business people in general, and they looked to move funds away from the bank to avoid any potential risks. So it's not that they were worried that there was a run on the bank. They were worried that there could be a run on the bank, but the worry that there could be a run on the bank is a reduction in confidence in that particular bank, which caused the banking run. And this is an example of exactly what I mean. Gary Tan, who's the president of the startup incubator Y Combinator, posted this internal message to founders in the program. We have no specific knowledge of what's happening at SVP, but anytime you hear problems of solvency in any bank and it can be deemed credible, you should take it seriously and prioritize the interests of your startup by not exposing yourself to more than $250,000 of exposure there. As always, your startup dies when you run out of money for whatever reason. So of course, you could see that when people read this, they look at what they have deposited at the bank, and they're just going to say, listen, we have multiple accounts at different banks, not just SVB, and so let's move some of those funds over just in case. Well, if everyone's doing that simultaneously, once again, you're going to get a run on SVB, which is exactly what happened. And so SVB, knowing that they're going to continue to suffer huge losses as these depositors continue to take money out of the bank, they tried to raise equity to just get more capital. And so, the share sale announcement led to the stock actually cratering in price, making it harder to raise capital. And it led the bank to actually cancel its share sale plans, which once again created more fear in the solvency of the bank. And so on Thursday, customers tried to withdraw $42 billion of deposits, and the bank just ran out of cash. And so their attempt at raising equity failed, and then they were just shut down because it was very clear that it was a situation that they couldn't get themselves out of. And now here's where this was leading up to. Remember earlier in the video, guys, I said that the Fed and the Treasury separately said that they would use emergency lending authorities to make more funds available to meet demands for bank withdrawals, which is an additional effort to prevent runs on other banks. And I said that this was the most important point, and I would explain later. Well, here's why. So I believe that the risk coming out of this isn't the contagion effects from SVP's depositors or the risks ultimately in the banking system as a result of the SVB collapse. Look, that is a huge risk, and you have to guarantee their depositors. You absolutely have to do that. But there's an additional risk here, and here it is. One of the big questions coming out of this will be which banks misjudged the match between the cost and the lifespan of their deposits and the yield and duration of those assets. And so essentially what this is saying is that if there's other banks that have done the same thing where they've purchased really long-term Treasury securities, and they get withdrawal requests much sooner than those securities mature, and so they have sort of like a liquidity crisis themselves, then you could see this risk spreading to those financial institutions as well, and ultimately taking confidence away from the banking system. And so that's why that last piece of the previous page that I showed you is the most important part. And so this is very different from the questions about bad lending that haunted the 2008 financial crisis. And so I really want to hammer in the fact that this is not similar. I mean, it could be similar, but it's not exactly the same as the 2008 financial crisis. And so I really want to point that out. And so banks reach for safe yield may be what haunts them this time around, which is very interesting, right? Because before they were reaching for yield, or I guess lending for higher yields, I guess, but ultimately they were lending to people that shouldn't have been able to borrow from the bank. And so this is where the contagion could be. It's not with who is impacted directly by SVP, it's also who misjudged the match between the cost and the lifespan of deposits. So I really want to hammer that point home. And so I do want to say that that risk is largely off the table, at least I think it is. And so at the time when I was recording this video, all of us were scrambling to understand the risks, and there were solutions being made to address the specific situations at each company. And so you notice that venture capital funds were extending short-term loans amid the cash crunch, while some founders were planning to even use personal funds to cover payrolls. But I think largely all of that panic has now gone away, and so we can just focus on business once again. And so now all eyes are on the Fed. And I made a point yesterday as I was building this out, and I just said, what a difference just 5 days makes. The probability of a larger 50 basis point increase fell to 40% from 70% on Thursday, as investors believe that the Fed won't act so hawkish in the face of recent events. Now, as a result of what was announced yesterday, does the Fed go ahead with their 50 basis point increase? I think they don't, just to make sure that this whole situation is cleared up, but we'll see how this plays out. I'm interested to see what the market believes in terms of what the rate increase will be. And I thought that this would be a little bit valuable for you guys. So this was made before any of the solutions were announced. And so, I asked the question, how am I addressing this situation with my portfolio? And the reason why I want to cover this one is because there was a lot of Patreons messaging me and saying, hey, listen, you should probably cover this, and just let us know sort of like how you're thinking about it. And so, as far as I'm concerned, the 2008 financial crisis was a big learning opportunity for me, but really what it did was it solidified a lot of what I was already learning from reading everything that I could from, some of the greatest value investors in the world. And so, this whole situation, I would say, doesn't change anything. And I just want to remind you guys exactly what I've been doing over the past couple of years. And, I don't want to say that I'm super intelligent or anything. In fact, I don't think I'm super intelligent. So this is why I act very carefully when it comes to the market. And so, what I did was I sold into the strength in 2021 and I ended up getting very cash flush. I also got bored, and so I just taught myself how to bake because, I can do research until I'm blue in the face, but I wasn't really finding many opportunities. I'm still not finding very many opportunities. If you're on the call with us on a monthly basis with the Patreons, every month I show you the market is still overvalued. I show you some opportunities that I think are undervalued, or at least in my opinion, they're undervalued, but there aren't much yet. And so, I'm still in this situation where I'm very cash flush, and, I'm still baking. And so, the tracker is key in this environment. I think the research is already done on many great companies. And so I think that during times of panic, it's not the time to start doing research. Never do research during times of chaos, because, you might not be rational in that environment. And so, the time to do the hard work is when everyone else is making money and super invested into the market, and you're thinking, the market is probably a little bit expensive, and so I'll pull out. But I'll wait. I have my valuations, and I have the tracker which tracks the share prices every day relative to their intrinsic value, and I'll snap them up if the market gives me any interesting opportunities. And so I'm looking at the tracker every day. I'm looking for large discrepancies between the price and the intrinsic value, and I really recommend that you guys should be building your own trackers as well with your own intrinsic values. And as I was a net seller into the strength, I'm going to be a net buyer into any potential weakness. And so once again, ultimately what I'm doing is the same thing that I've been doing all along. Let's see what opportunities Mr. Market provides us in this environment. And so if you guys aren't aware what the tracker is, this is what the tracker looks like. You get access to this at the lower level of the Patreon, and essentially what it does is you can actually click into this ticker, and it brings you to a granular model for the particular company. And on the tracker, it lists all the companies that I've done research on, and I've provided my own personal opinion of what I think the companies are worth. It's not investment advice for you guys in any way. It never is. But what it really shows you is how to build out models and sort of like how to track it using a tracker, because you can see all the formulas and all that stuff. And so you can see that Alibaba is trading around 83 bucks a share. I believe that it's worth around 223, and so the share price as a percentage of its intrinsic value is under 40%. And you can see there's a whole slew of names, but not a lot of names under 75% of their intrinsic value at the moment. However, the tracker becomes very important once again during times of market chaos. And so we'll be able to pick up really quickly if the market gives us any wonderful opportunities. And once again, when you're cash flush, it's almost just like come to me with respect to the opportunities. And so if you want access to the tracker, you can get access to it at the lower tier. But I think the most important value on YouTube really is this live presentation that we do every month, where I save my best work for. Now, I want to know from you guys, what do you think? Do you think that there's more contagion here? Are there risks that I haven't understood, or are there risks that could come from this? And so let me know in the comments below. Also, I actually did a full breakout of, what Jerome Powell said, which led to him suggesting that there's going to be a 50 basis point rate increase. And so if you've missed that video, you can get to it right here.